Hi everyone, welcome to my channel again. Today I am going to share about payback period. Before watch, please like, comment and subscribe my channel. Your support will encourage me to produce more video related to Lean Six Sigma and operation management. Corporate finance is all about capital budgeting. Capital budgeting is the planning process used to determine whether an organization's long-term investments such as new machinery, new plants, new products and projects are worth the funding of cash through the firm's capitalization structure. What is payback period? The payback period refers to the amount of time it takes to recover the cost of an investment. Simply put, the payback period is the length of time an investment reaches a break-even point. What is an acceptable payback period? An investment can either have a short or long payback period. A shorter payback period means the investment will quickly be recovered by the cash flow that investment will generate. The payback period of an investment is best applied as a screening calculation between options. It gives the investor to decide whether a particular investment is worth examining in greater detail or can provide a relative ranking of alternatives in terms of payback options. The payback period is the cost of the investment divided by the annual cash flow if cash inflows from the project are even. For example, Company C is planning to undertake a project requiring initial investment of $105 million. The project is expected to generate $25 million per year in net cash flows for 7 years. Calculate the payback period of the project. Solution. Payback period is initial investment divided by annual cash flow. Equals $105 million divided by $25 million. The payback period is 4.2 years. Disadvantages of payback period are: first, payback period does not take into account the time value of money, which is a serious drawback since it can lead to wrong decisions. A variation of payback method that attempts to address this drawback is called discounted payback period method. Secondly, it does not take into account the cash flows that occur after the payback period. This means that a project having very good cash inflows but beyond its payback period may be ignored. For example, if an asset's useful life expires immediately after it pays back the initial investment, then there is no opportunity to generate additional cash flows. The payback method does not incorporate any assumption regarding asset lifespan. Finally, the payback method focuses solely upon the time required to pay back the initial investment. It does not track the ultimate profitability of a project at all. Thus, the method may indicate that a project having a short payback but with no overall profitability is a better investment than a project requiring a long-term payback but having substantial long-term profitability. In summary, the payback method should not be used as the sole criterion for approval of a capital investment. Instead, consider using the net present value or internal rate of return methods to incorporate the time value of money and more complex cash flows, and use throughput analysis to see if the investment will actually boost overall corporate profitability. Thanks for watching. Bye, see you next time.